In this video of our multi-video seller series, we shall look at the appraisal, homeowners insurance and the flood elevation certificate, as these are very important lender requirements. They are not items that are mandatory when a seller has a cash buyer contracted to purchase his or her home, though it is still very important for a cash buyer to take out homeowners insurance on his or her home at the time of purchase, and also flood insurance if the home is shown to be in a flood zone. Here are 8 points of note when considering these topics.
Number 1. What is an appraisal? An appraisal is the estimated value of a property, determined by an inspection of the property by an appraiser and its comparison to similar recently sold properties in the area. Appraisals are ordered by a buyer's lender and can be performed on any type of property on which a lender has been asked to provide a loan. It follows, therefore, that appraisers can be asked to provide an estimate of value on a residential home, be it a single-family home, townhome, mobile home, condominium or multi-family unit. Appraisers can also be asked to provide a value on commercial properties and on land. Cash buyers generally do not rely on an appraiser for a valuation and look instead to the buyer's agent to provide a valuation for them based on similar recently sold properties. Appraisals are a lender requirement and as such are paid for by the buyer, usually as an upfront payment prior to the appraisal order being placed by the lender.
Number 2. Timing of the appraisal. Once the buyer has completed his or her loan application, the buyer's lender will order the appraisal to be performed. If the buyer and his or her agent is fearful that the home may not inspect very well and that the buyer may elect to cancel the contract after the inspection outcome is known, then they may request the lender to delay ordering the appraisal till after the inspection has taken place. This way, the appraisal can be ordered once it is known that the buyer is satisfied with the inspection outcome or has negotiated a satisfactory repair agreement with the seller. This prevents the buyer paying out for both an inspection and an appraisal and then not proceeding with the purchase.
Number 3. Outcome of an appraisal. Should the appraisal bring in a higher value than the contract price, then the buyer is a happy camper, knowing that the home was valued higher than the price he or she is paying for the home. Normally, if this is the case, the seller is not told the appraisal value and the buyer proceeds forward to closing. Should the appraisal value bring in a lower value than the contract price, then we have a problem, as the lender will only lend money based on the appraisal value. The buyer may find him or herself having to bring additional funds to closing to bridge the gap between the contract price and the appraisal value. This may be money that the buyer just does not have available. One way to avoid this being the case is to ask the seller to reduce the contract price to the appraisal value, or the seller may be asked to at least partially reduce the contract price to partially bridge the gap between the contract price and the appraisal value. If the buyer and seller fail to come to a meeting of the minds on this issue, then the contract may be cancelled and the buyer refunded the escrow deposit under the financing contingency.
Number 4. FHA, VA and USDA Low Appraisals. Unlike appraisals for conventional loans, appraisals ordered for these 3 loan types stay with the home for a certain amount of time. Thus, should a buyer of a similar loan type contract to purchase the home, that low appraisal will be the appraisal that has to be used by the lender. FHA and USDA appraisals will stay with the home for 120 days and a VA appraisal will stay with the home for a whole 6 months. This will mean that if a seller has had a sale fall through on account of a low appraisal for one of these loan types and the home has to be placed back on the market, it will behoove that seller to not accept an offer from a new buyer of that same loan type.
Number 5. Contesting an appraisal. Appraisals are an art rather than a science, and by that we mean that it is unlikely that 2 appraisers would bring in the same value on the same property. In cases when the listing agent feels that the appraisal was not a fair appraisal, the agent may contest the appraisal. This is done by completing some required paperwork for the buyer's lender, which asks for the appraisal to be changed. The agent would then be required to present more appropriate comparable sales on which the agent would like the appraiser to base his or her value of the home. The listing agent will be notified in a matter of a few days by the lender if the rebuttal of the appraisal has been successful.
Number 6. Waiving the appraisal contingency. In a situation where there are multiple offers on a home, a buyer may elect to either partially to some monetary degree or completely waive the appraisal contingency in order to present as a stronger candidate. This is especially applicable if the offers are all high offers over what would be the expected appraisal value of the home. Offers over expected appraisal value which do not waive the appraisal contingency are unrealistic offers. They are not meaningful if the buyer is going to come back to the seller after the lower appraisal value has been brought in, expecting that the seller will now lower the contract price.
Number 7. Homeowners insurance. The lender is going to require the buyer to have homeowners insurance in place before the buyer can close on the home purchase. The buyer will be able to shop around the many homeowners insurance companies to find the most attractive insurance package. As already mentioned in a previous video, the age of the roof on the home is of paramount importance when obtaining homeowners insurance, as most insurance companies will not insure a home unless the roof on the home has at least 3 years of useful life remaining. Of particular note in the state of Florida is the fact that in hurricane season, it behooves a buyer to line up his or her insurance well in advance of closing. Most insurance companies will not write any new policies when a hurricane is within 48 hours of impacting a given area. This may mean that a closing may have to be extended if the buyer is not able at that time to obtain homeowners insurance.
Number 8. Flood elevation certificate. Having mentioned homeowners insurance, let us further add that if the home loan is going to be insured or issued by the government, as in the case of FHA, VA and USDA loans, an elevation certificate may be required before the loan will be approved to determine if the home is in a flood zone. If it is, then the lender will require the buyer to get flood insurance. This additional increase in the insurance coverage may affect the monthly payment to such a degree that the buyer may no longer qualify for the loan due to his or her debt to income or DTI ratio being too high.
Thanks for watching, and make sure to check out the rest of the videos in our seller series.